So welcome to all of you who are joining either live or recording. Before we begin and share our slides in relation to this How Money Works webinar, I just want to briefly hand you over to John to say a quick hello, and then we will kick off.
Hi everyone. I hope you can hear me loud and clear. You're very welcome, and I'm delighted to join today. I suppose the purpose of this short little webinar is just to have a quick chat about some of the very kind of first stage financial products that exist in the market at the minute. Aisling will probably lead off on the presentation, and then I'll join back in when we get onto the mortgage side of the house, pun intended.
Perfect. Thanks, John. And just to note that the chat is disabled for the purposes of this webinar, but the Q&A function is open. So we would recommend you include your questions as we go along. We'll have time for questions at the end. So the purpose of the first part of the session will be for us to discuss our slides, but then we will be handing over to any questions that you might have in the meantime. So we're happy to take any questions. So let's just kick off. And if you have questions as you go, as I said, please do feel free to use the question and answer function in the corner. So to begin with, just double check that you can all see my apologies. We'd started at the very beginning. So just to begin with, I just want to note again that myself and John work with the Funds Academy, which is a project between Munster Technological University and Southeast Technological University. We run a number of programs in the investment fund sector, and if you would like to investigate any of our programs, look into them further. If you're interested in investment funds, do feel free to have a look on our website, fundsacademy.ie. Now, first and foremost, just to remind you all that we are not financial advisors. You hear that all the time, but it's really important that we reiterate that. John and I work in financial education as opposed to giving people financial advice on where best to place their money. So it's important to understand that from the get-go. So we won't be necessarily advising you on particular products that you should or shouldn't save with or invest in. But what we can do is hopefully demystify some of the language around savings, budgeting, and mortgages when we get to John's section. In the first instance, I want you to pique your interest by thinking about the purpose of money in today's society. Is money important? I'm sure most of us here would answer the affirmative in relation to that question. And I suppose what I want to think about is, if so, why is money important, and is understanding how money works important? You've taken the first step by being at a webinar in relation to financial advice, or not financial advice, rather financial education. And I guess there has been a massive increase in focus on financial literacy, particularly in Ireland over the past year. We have not come out well in the European ranks of financial literacy as compared to our European peers, and whether that's testament to a lack of financial education at an earlier stage in primary schools and secondary schools, or otherwise, it's something that the state are really seeking to rectify in the coming years, and in hopes that people can take control of their own financial well-being and get an understanding of the various products on the market so that they are more informed and can make more informed decisions. Okay, so I guess first and foremost, I'm going to be chatting to you a little bit about budgeting and saving, and then I'm going to be handing over to John, who will hopefully demystify some of the very dense terminology around mortgages that you might hear on the radio, on television ads. But in the first instance, I guess, what is a budget? Many of you might think to yourself, well, obviously I know what a budget is, but most people don't actually have a formal budget. So I just wanted to break down what a budget is under the Money Advice and Budgeting Services definition. And it's effectively a plan that helps you manage your money, first step to taking control of your finances, and it helps you figure out how much money you get, spend, and save. It takes a bit of effort, but can really pay off, okay? Before I talk about the different types of budgets that you can put in place at a very high level, I want you to start thinking about now, what are the categories that would fit within your budget, okay? And this will look different to everybody. You will all have different outgoings. You'll all have different commitments. Some of you may have debt repayments that need to be paid. Some of you may have no debt repayments. Some of you may have higher incomes. Some of you may have lower incomes. So everybody is operating within a different framework. So I guess what I wanted you to think about is, okay, if I had to list out all of the categories of budget that I have to pay for every month, what would those be? And I just want to give you an idea of some of the examples, and you can maybe take note of some of these. They might be useful when you're creating your own budget. I think first of all, you need to think about your goals. Then you need to think about your income. Then you need to think about your needs and wants. Okay. So a goal can look like, I want to buy a new car, or it can look like something as small as I want to be able to afford a coffee every Friday. You know, it can be very different depending on your own, you know, your own priorities, depending on what your preferred lifestyle looks like. But in any case, it's always good to have a goal when you're planning your budget. Okay. In order to ascertain how quickly you can achieve your goals, you're going to need to look at your income. Okay. What is your income? Is it social welfare payments that you get on a weekly basis? Is it a salary that you get paid weekly, bi-weekly, monthly? Or otherwise, perhaps you have other sources of income. Perhaps you have rental income. Perhaps you have a side business where you are making sales and you get income from those sales, for example. So it'll look different to every individual. And then when you're creating your budget and creating your goals for your budget, that you're going to have to consider what are your needs and what are your wants. Okay. And when you're ascertaining what your needs and your wants are, there are a number of different categories you can use. Okay. So first and foremost, most people will look at things like housing. Okay. Housing, a housing payment under your budget line could either look like a rental payment, it could look like a private rental payment, it could look like a council rental payment, it could look like a mortgage payment. And John will talk a little bit more about mortgages shortly, where you buy a house and you take on a mortgage from the bank in order to be able to finance that property. Okay, so a housing payment will generally be a very large outgoing in most people's budget, unless they're in the fortunate position that they don't necessarily have a housing payment. Maybe they've paid off a mortgage, maybe they're living with family members and not having to pay rent, but that will often be one of the highest line items in any budget. You may have childcare if you've got children, childcare costs. You may have transport costs, utilities. So what are utilities? You're looking at things like your aircom bill, your air bill, your 3 mobile bill or your Vodafone bill, whatever it might be. So your various bills for different things, electricity bills, for example. You might have your food and groceries bill. Well, most of you, I assume all of you, will have some kind of food or groceries bill, unless you're lucky enough that somebody buys all of your food and groceries for you. And then you have the category of savings. Okay, so savings is something I'll get to shortly. And then I have these categories, which people often leave as kind of ancillary categories, but equally important in some instances. So you might have an entertainment line item within your budget. You might have healthcare. So are you paying health insurance? Healthcare is something that if you don't have health insurance, it might just be an ad hoc expense that comes up from time to time if you need to go to the doctor. Or it could be a more consistent payment that you make every month out of your budget. Insurance then obviously is fundamental. Do you need car insurance? Do you need house insurance if you're a homeowner? Do you have a pet? Do you need pet insurance? Personal care, things like, do you go to the barbers every couple of weeks, or do you go to the hairdressers every couple of months? Are you factoring that in? Debt payments, obviously very important, and we'll chat about that shortly as well, and the impact that different interest rates can have on debt. Gifts, that can be another category, and donations. So the reason I have these two slides is people often think, okay, I need to think about my housing, I need to think about my food, and I need to think about miscellaneous. But actually it can be easier to create a budget if you go a little bit more granular and you think, well, what are my actual outgoings and how does this impact my day-to-day spending? You might think to yourself, okay, well, I only go to, the hairdressers 3 or 4 times a year, so I don't have to think about that. That's not a common spend. But actually what you can do is you can create, a recurring payment into a savings account to siphon off a little bit of money, so that when that time comes, you're not trying to pull from nowhere in order to pay for a large hairdressing bill, or for something that you might see as an ad hoc expense. So those are the different categories that I just wanted to very briefly flag. I'll just pause there to see if there's been any questions or anything pressing, but I don't think so. We might keep it to the end. That's perfect. Okay, so just to flag then very briefly different budgeting techniques that you might use. Okay, you might think these are very obvious, but some people might not necessarily think about using a formal budget. You might just think, okay, I'll spend my money until it's gone, and then I'll hope that more money comes in, which is also an approach that many people use. But I guess there are a number of ways that you can use to track your money. So the first way of tracking your money essentially is a money diary. And anyone listening who thinks, okay, that sounds like the most boring thing in the world, keeping a money diary, it can be useful in order to ascertain where all of your outgoings are going if you're not sure. If you're thinking to yourself, I earn a good wage, but I'm not sure where my money is going. By keeping a money diary, suddenly you're establishing, oh, hang on a second, I'm actually spending 380 on a latte every morning and every afternoon. That suddenly adds up. 380 by 2, suddenly 380 by 14. If you're doing it 7 days a week, it can be an exceptional impact on your budget. So keeping that money diary can show where small amounts are being accrued to have a large impact on your bottom line. Okay. A zero-based budget then is where every euro in your account gets given a job. Every euro in your account gets given a job, and you allocate it out until there's nothing left in the account. So that might look like, you know, you're allocating a certain spend to your housing, your food, your entertainment, your personal care budget, whatever it might look like, and all the way down to your savings, so that effectively there's nothing in your account that you don't know where that money is going. Okay, so that's a zero-based budget. Some people find that really useful, and it means that you're not having to ascertain, you know, well, how much do I have left to work with? You know exactly how all of your money is being put to work. Okay. For those who might work with cash, some people prefer an envelope technique, which is a little bit more old school in this modern fintech society that we're living in, but it might work for some of you. And that's effectively where you've envelopes, where you give yourself a certain amount of cash for each line item every month. Now, it might not work, for example, for rent. If you've got, you know, 800 or 900 euros of rent coming out every month, for example, I'm not sure you're going to be stuffing that into an envelope and passing it through your landlord's letterbox. But for other expenses, whether it's your grocery expense, whether it's money for the barbers, whether it's money for sports, whatever it might be, having a separate envelope so that you know when that money is gone, it's gone, can be very useful for people who are trying to start imposing more limitations on their spending, trying to get a grip on their spending. And for example, if you have 50 euros in your coffee envelope and you get to the bottom of that, you know, halfway through the month, then at least you know then that that's the money that you've allocated for coffee, and maybe you'll start making your own coffee for the rest of the month until you get paid again. Pay yourself first. This is the method whereby you make sure that you're paying into your savings before you pay anything else. Okay. So when you get paid, whether you get paid once a month, once every 2 weeks, once every week, effectively you immediately siphon off money. So it's like you don't even see it. So say you get paid and you immediately send 200 euros. Often people will set this up as a kind of an automated transfer from their account into a savings account. Then that's a method that you can use in order to, you know, make sure that you're not counting on the money for spending. It's money that's going straight into your savings account, and you get used to that going into your savings straight away. And then finally, the last budget technique I wanted to mention is the 50-30-20. Okay. Now this will only work in some instances. You know, some people might say, well, I would love to have the luxury of only spending 50% on needs. So it's 50% on needs, 30% on wants, and then 20% on savings and debt. Okay. That won't always work for everybody. For example, if you've got very high interest loan repayments that you need to make, they might be way higher than the 20% of your income. And that may not work. However, a lot of people say that 30-20 is a nice balance to try and strive to achieve. Okay. So it may look like, you know, reducing your outgoings in some instances so that you're not spending as much in the wants category, but rather you're siphoning some of that want money that's being spent into your savings or into debt repayments so that you can pay off debt a little bit quicker. Okay. We chatted about savings very briefly, as I spoke about it as a category of budget, but I just wanted to note, you know, everyone thinks, okay, savings, would love to save more. What are savings? Well, effectively, savings is any money which we do not spend, but rather accumulate over time, money that we earn, but we keep. Okay. Generally, a savings account is with a bank or credit union designed to hold your money. Typically don't pay a huge interest rate, but they're considered safe. Okay. So John and I work in the investment fund space. That's a whole different kettle of fish where you're investing your money. Savings accounts are rather money that is kept in the bank on deposit for you. Okay. Just to flag very quickly what's been happening with savings accounts over the past year in relation to interest rates. So John will be chatting about interest rates in the context of mortgages and in the context of the European Central Bank, which sets European interest rates. But I just wanted to flag it specifically in the context of savings. So what happens is the European Central Bank sets an interest rate, okay, that basically that all of the banks in the EU then are having to abide by, because what will happen is if the European Central Bank sets an interest rate at, you know, 2.5%, etc., that's the rate that the banks themselves will get if they are using the European Central Bank as a central service. Okay. And what happens is that gets passed on to the customers. So you'll have heard in the context of mortgages going up and down if you're on a variable mortgage or a tracker mortgage, but it also happened with savings rates. So when the European Central Bank sets a rate at 3%, 4%, which they did in the last year, the banks then get under pressure to pass that on to the customers, because that's the rate that they're getting from the European Central Bank. So often the central banks don't necessarily pass that on straight away. Sometimes they'll be dragging their heels and they won't offer you a great savings rate. But then after a few months, they'll come under pressure from the government and the Central Bank of Ireland, and they might do something about it. So last year, for the first time in a long time, banks were offering much better savings rates. So there were fixed term accounts, for example, being offered at 3%. So if you put in 10 grand, you get 3% on that, as long as you locked it up for a certain period of time. Now, the trend that we've been seeing is that as those rates have been falling, the amounts of interest that you're getting on these accounts are falling as well. So all of the banks have recently cut those fixed term products that they've had. So just to flag that, when the rates are high, it can be bad for mortgages, but good for savings. When the rates are low, then it can be good for mortgages, but you don't get as much on your savings, okay? And just to flag the types of savings accounts before I hand over to John and to chat a little bit about the mortgages, you'll see, these terms used quite regularly with different banks. So deposit accounts, they're just your basic current accounts that you might use. Savings account, including regular monthly savings accounts, so they might have a nominal amount of interest on them, depending on the rate that the banks are offering at the time. You'll see often regular monthly savings account where they'll allow you to put a certain amount in every month. So you might say 500 every month, for example, and if you commit to saving that amount every month, you might get a better interest rate, for example. Fixed rate, fixed term products such as savings certs and savings bonds. You might hear of prize bonds, for example, with the post office. They offer savings bonds. And fixed term and fixed rate, fixed term accounts then are also where you put all the money in one go and leave it to mature over a certain period of time. So you lock up your money for a certain number of years, and you'll get a better interest rate often if you do that. Why? Because it means that the bank is sure that you're going to leave the money with them. They can use it for investments themselves in the background. They don't just let it sit there. They'll use that money, they put it to good use, and then ultimately they have to pay you back after the fixed term is up. Okay. As I mentioned there, it was the fixed terms that were looking pretty good last year. So I know there were a couple of fixed term accounts being offered at 3% in AIB, PTSB, etc. But a lot of those now have started coming down because the ECB rates have started coming down as well. So if you got your money in and locked it in last year, then you're safe because it's fixed term. That's what you signed up for. So you'll get that rate every year for the 3 years, for example, that you're locked in. But if you lock it in now, you may not get as good a rate. Notice accounts then, where you have to give notice before withdrawing the funds, or sometimes there'll be a little bit of a fee if you withdraw too early. Regular saver accounts, I've already mentioned that up in the second category there. And then often you'll have demand accounts where you need to give notice as well. And then finally parent-child accounts. Okay, so you might set up an account for the benefit of a minor, for example. Okay, I'm conscious I've spoken for quite a bit, and we need to move on to the more interesting topic of mortgages. I do see there's one question there from Megan. I might save it for the very end if that's okay, and I'll pass on to John, and we'll address all questions at the very end. So thank you so much for listening to me around budgeting and savings, and I'll pass over to John.
Yeah, I suppose I guess thanks, Aisling, and I'm going to chat a little bit about mortgages. I suppose they're in the news again these days because of kind of some of the flux that's going on in the markets. And Aisling was talking about interest rates and how interest rates are falling from the perspective of savers. Well, they're also falling from the perspective of borrowers, which is good news for borrowers. And it's now possible to get mortgages. Probably the most competitive rate in the market is now in and around 3%. And it goes up beyond that obviously as well too. So there is, I suppose, some good value on the mortgage side of the house to be gotten at the moment because interest rates are coming down, and the expectation is that they might come down a little bit more. Just a kind of as we're chatting about interest, a little kind of a very kind of I'm not going to get into interest calculations. It's probably we'd be doing maths until we're nearly dead and buried if we were doing that. But I suppose all savings and mortgage products that the banks offer, they tend to use what's called compound interest. So they typically would offer interest on interest. Now that's handy if you're a saver, because you then get, when you put your money on deposit, you get a bit of interest that gets added to the original money you put on deposit, and it gets interest on the interest. So you can do quite, over time, you can do quite well if you're prepared to leave your money aside for a long period of time. It probably, and you'll see it come up again when we look at mortgages. I suppose it means that you'll end up paying a very high amount of interest at the start, because you've got such a large sum borrowed, and each time you pay off some, well, actually, you're going to end up paying quite a large amount of interest every time, until you're getting towards the end of the life of a mortgage, when then the interest element of your payments become quite small and the principal elements get quite large. So what works in the favor of savers might to some extent work maybe against borrowers, but it's a standard practice across the banking system. If you flick me on a slide there, Aisling, and so
Sorry.
just then, because I don't have control, do I? No.
No, I think we have
No,
it there now.
no.
Yeah, go for
So
it.
just then, what is a mortgage? I'm sure everybody kind of has a reasonable appreciation for what a mortgage is. It's typically the name that we give to a loan that's used to buy a house. That's usually the idea behind it. But I suppose what sets it apart from many other kind of a standard kind of loan is that because it's called a mortgage, then that means it is secured on the property itself. And that's why you'll often hear in the adverts, if failure to keep up on your repayments may mean that you might lose your property or whatever. And that's because this is what I suppose gives the bank a bit of security, insofar as that if you take out a mortgage and then you can't meet the repayments, and you go through a process, it's not, the minute you fall apart behind in one payment, they're not going to seize your house and do that. But there is a process that they've got to go through. And if you miss numerous payments, then the bank may be in a position to repossess your house and then sell it off to pay down what remains on the mortgage. That's really, for most banks, by the way, exercising their security is pretty much the last resort, because it reflects, but it's not great for their business. It's time consuming, it costs money. It's so they much prefer to see people in back making some kind of repayment, and they can exercise a reasonable degree of forbearance, at least anyway, with people. So if you're in this particular boat and you're finding it difficult to make your repayments, the advice always is to talk to your particular lender, to talk to your bank, and come to some kind of negotiation. The other, I suppose, feature of a mortgage then is that repayments are typically spread over quite a lengthy period. So I suppose there was a time when the standard period was in between 20 and 25 years. Now people tend to borrow for maybe up to 30 years. But that's quite a long period of time to take out any kind of a loan. If you take out a car loan, or if you take out any other kind of financial product like this in this area, you would typically be looking at a much shorter term. But because it's a mortgage and because it's on your property, then that can facilitate a longer term in the kind of the area of 20, 30, even up to 35 years, but that would be typically quite unusual. Then once you do, how do those repayments look? Well, they're typically monthly. You make a mortgage repayment every month. It comes out of your account like a direct debit, just like as if you're paying rent. So that's why a lot of people, when they look at mortgages, the calculation is, well, what am I paying out in rent versus what would I end up having to pay out if I owned the property and was repaying on a mortgage? And from time to time, that gap between the two, between the rental payment and the mortgage repayment, that kind of can narrow quite a bit. My understanding is that at the minute, a rental payment on a property and a typical mortgage on a property, the gap is quite narrow. And that's just a function of our kind of what would be our dysfunctional property market that we have in this country at the minute. But nonetheless, it's a monthly repayment. Every time you make a repayment, be it at the start of the loan or at the end of the loan, you pay interest and you pay a bit of principal back. The principal is the amount that you've borrowed, and the interest then is the bank's margin on that. So at the start of a loan, initially, that amount, when you make a repayment, you might be making a repayment, say, of €1,000 a month. 980 euros of that could be interest and 20 euros could be principal. By the time you get to the very end, 25 years later, that nearly flicks. It nearly reverses. And in that case, 970 or 80 euros would be a principal repayment, and 30 euros might be an interest repayment. And that's only because when you're at the very start of the life of a mortgage, the amount you've borrowed, the principal, is quite large, and therefore you kind of chip away at it over time. The repayment is calculated in such a way so that you pay the same amount every month. Now that is stable until the interest rate changes, and we'll chat about kind of the options as regards interest rates in a little while. So you might have a mortgage on a property. It'll be the bank, you take out the mortgage, your repayment might be 1,100 euros a month. It will stay at that 1,100 euros a month forever and a day, unless the interest rate goes up or down, in which case then it may, depending on what kind of a mortgage you're on, then you might end up having to pay a little bit more or having to pay a little bit less. But I suppose the idea of this is that, and can refer back to Ashing's conversation around budgeting, this becomes much easier to budget when you know it's likely to be 1,100 euros every month for the foreseeable future, at least anyway, until interest rates do change. And usually for most people, the mortgage repayment or the interest or your rental payment that's the largest expense that you might have out of the household budget. Okay, I think I've more or less chatted through everything that's on that. So what we might do is we might like have a look at kind of the process behind this and how it might work. So usually, I suppose we'll if you're looking to buy a house, it doesn't normally start with buying the house in this day and age. The first thing that you need to do usually is maybe think about saving for a deposit, because you need to have a deposit in order to be able to buy a house. Now, you might, depending on your situation, you might have family members might help you with that. But if you don't have that, you will have to set aside some cash each month in order to have that deposit built up, because the banks will not be permitted to lend to you unless you have some of your own money. In other words, your own equity is what it's called, but your own deposit to put down on the house. But once you have the deposit saved, then you apply for your mortgage. You can go, I'll talk about the different mortgage people that are not maybe the mortgage lenders that are out there, but a tool that where you can compare mortgage lenders against one another. But you can have a look at the different mortgage lenders, and then you go into one of the banks or specialist lenders, and you apply for a mortgage with them. Yeah, if, say, for example, the typical kind of setup, if your house is 250,000 euros, you would need to have at a minimum a deposit of 10%. So that's one of the rules that the banks must adhere to. They will always look for a deposit of 10%. That'd be 25,000 euros, and therefore they would lend you the balance of 225,000 euros then, and that then will allow you then to be able to buy the house. And usually that's what I suppose restricts most people in how much they can spend on a house, because if you want to buy a house that's worth 300,000 euros, then you need to have a deposit of 30,000 euros set aside. And the further up you go, the more money you need to have in a deposit. And that's quite often a constraint that's limiting people spending and borrowing more money on a house. I suppose in reality, what are the rules? Well, there are actually two rules. One rule is on the loan to value. That's that 10% piece that I was chatting about. So you must be able to contribute yourself from your own resources 10% into the pot, and the bank will give you the other 90% of the value of the house. And the other rule then is that your salary must be a multiple, or well, the house cannot be more than a multiple of your salary. So the rule is you cannot borrow more than 4 times your salary at the moment. If you're a first-time buyer. If you're a second-time buyer, it's 3.5 times your salary. And that's for, if there's 2 people buying, then you can combine the two salaries together and multiply them up. So in the example that I have here in the gray, if the house is 250,000, you'd want to have a salary of 60. I do mental maths in my head here, but 62,500 I think is what it looks like. So 62,500 is what, if you're an individual or a couple, that's what the joint salary needs to be, 62,500. If you want to buy a house that's worth, say, 400,000 euros, then your joint salary must be 100,000 euros. So again, as the value of the house goes up, then you need to have a higher combined salary, and you need to have a higher deposit. So it becomes harder and harder, I suppose, for people to buy houses that are, I suppose, out of their price range, if you want to call it that. And these rules are not set by the bank. These rules are set by the Central Bank of Ireland, okay, the regulator effectively, to stop the banks lending too much into the market. Because the difficulty is that at the moment, houses are scarce and houses are expensive. But, if they were to relax these rules, it wouldn't necessarily end up that there would be more houses available. All that it would do is that everyone would end up having to pay more, and the people who would lose out those circumstances would be the buyers of houses. So those rules exist to protect banks and also to protect consumers as well too from paying too much. Um, there are kind of flexes to those rules as well too. The banks do have a little bit of flexibility around exactly how much the salary and how much the loan, but we won't get into that in too much detail. They tend to be at the margin rather than in the main. Then what kind of a mortgage should you go for? There's typically, I suppose, three, and in reality, two types of mortgages. There's the three are fixed, variable, and tracker, but the tracker mortgage doesn't typically exist much anymore. The two main kind of mortgages is fixed and variable, and what that is referring to is referring to the interest rate that you pay. So if it's fixed, then your interest rate is fixed for a period of time. Now you can fix it for whatever period of time you would like. You typically see 3, 5, and to a lesser extent 10-year fixed rates, but 3 and 5 is very much the standard. So very often people might fix a mortgage for 3 years or for 5 years, and then once it comes off, once the 5 years are up, then you have a chance. You can either go back and refix again, or you can go back and fall back onto variable. Variable means that the rate varies up and down depending on what's happening in the interest rate markets. Now, at the moment, it looks like ECB are going to be lowering their interest rates the next time around, but they might not. And who knows what's going to happen in 3, 6, or 8, 9 months' time. So there's uncertainty. So you take risk. If you go down variable, you take risk because the rate might go up. Now, the rate might go down as well too, and you end up paying less. But nonetheless, you are taking a risk, and you might end up paying more on your monthly repayments. And quite often, certainly kind of first-time buyers are often encouraged to go in the initial years anyway to go onto a fixed mortgage, but it's that's your own personal choice and decision. Tracker mortgages are mortgages that are tracked against the ECB rate. So the ECB rate at the moment is in and around, I'm just checking it here, I think it's about 2.65% for the lending rate. You would that the rate that you'd be offered by the bank would be 2.65% plus a margin. It might be 0.5%. So then you would add on 0.5% and that'd be a rate. If the ECB rate drops, then the bank is automatically obliged to pass on that rate to you. If the ECB rate goes up, then the bank is automatically obliged to charge you the extra amount. So, I mean, a tracker rate is not fixed. A tracker rate is a variable rate, except it's variable based on the underlying ECB rate. The problem with a variable rate is that it's up to the banks. It's the bank's decision as to whether or not they wish to pass it on or not. If you flick on there to the next slide, lovely. This is one of the newer innovations, sustainable finance and our mortgages. This is one of the newer innovations in the mortgage market, maybe only over the last 2, 3, 4 years. And I suppose how it's like you might ask the question, how the hell does climate change impact on finance? It surely doesn't have anything to do with it. This is all about, you would think that climate change is about, burning, using less oil, burning less coal, buying electric vehicles. That's where mainly climate change is. But actually, one of the big impacts on climate is houses and how we heat our houses, particularly in this country. And if our houses are thermally inefficient, then that does have an impact cumulatively across the entire economy on our carbon emissions. So what the banks have done as part of their response to the climate crisis, and they borrow based on this as well too, so they're not doing this out of the goodness of their hearts for sure. But if your house and the house you're hoping to buy has got a favorable BER rating, if it's A rated or B rated, the banks will offer you a lower rate of interest on your mortgage than if it was an E, F, or G rating. So the BER rating that's attached to your home can have an impact on the interest rate that you will be charged by the bank. And it can be relatively substantial. The gap between A and G by some lenders is up to about 0.75%. So that can have, whether you're paying 3% or 3.75%, that can have an impact on your monthly repayments, particularly as the mortgage amount the principal gets bigger. I did mention that there are some mortgage interest calculators out there. The one that I will, I suppose, not so much advocate, but the one that's mentioned here is for ccpc.ie. Okay, so that's the Consumer Protection Commission. The reason, I suppose, why I have mentioned that one is because because this is effectively a government-run entity. So it's relatively independent. They're not trying to sell you something. There's no kind of advertising going on in the background as you might get with some of the other comparison websites. So this would be seen as independent government, quasi-government provided tool. And if you go in there, you can put in your own details, what do you want to buy, over what period you want to lend. It'll even ask you for your BR rating if you know it, and you'll then see what your likely payments are going to be. And it's not a bad site to go through. Then what do you need to watch out for if you are looking, or if you're thinking about mortgages? Well, the first thing you might need to know, if say, for example, you're going on a fixed rate mortgage for, say, 3 to 5 years or whatever it might be, and you might want to ask, well, what happens when you get to the end of that fixed term? Are you then is it automatically that you get flipped onto a variable rate, or will you have the option to maybe refix again? Now, typically, most banks will push you down to their standard variable rate, but it's quite often it's worth your while to have a quick look around. If you're coming off a fixed rate, it's quite often worth your while to have a quick look around, talk to the bank that you've got the loan with, and maybe have a look at what other banks are offering as well too, because you can be surprised that just because, as an example, AIB might be very competitive now, in 5 years' time, which could be the end of the fixed term, things might have changed a bit and you might get a better deal from somebody else. Can you switch while you're on a fixed rate? Well, you can do whatever you like, but the reality is typically most fixed rate mortgages, if you want to get out of the fixed, you will be charged a penalty. So, for example, if you were on a fixed rate with AIB and you want to switch to somebody else, you will be charged a penalty to leave that particular contract. If you are on a fixed rate with AIB and you want to move on to another AIB rate, it might be a variable rate because you've seen that the variable rates have come down. You will also probably be charged a penalty for doing that as well. So if you're looking to kind of move around like that, your best bet is to seek some kind of advice to see what is the impact going to be on your monthly repayments. Who sets the variable rate? Well, the ECB sets their rates. That's what determines what the banks can borrow and lend at, but it's up to the banks to decide whether they wish to pass that rate on to you or not. So quite often, just because the ECB rate comes down, you may not necessarily experience a decrease in your mortgage repayments. And it's up to individual banks to change their rates. And usually, because the market's quite competitive, if one bank moves, then the likelihood is that many of the other banks will move as well. Okay, but it's not necessarily always the case. So it's always worth your while, to keep an eye on these things in case you might be able to get better value elsewhere. Now, there is a cost with switching, but again, all you got to basically sit down and go through the numbers and see if it's worth your while to move around and move your rate, or to switch. If you're on a variable rate, you've got considerable flexibility. You might then be able to move on to a fixed rate. Can you make additional or earlier repayments? Again, because remember what I said earlier, when you look at your mortgage, what typically happens is that you might have borrowed for 25 years. In the early years, a lot of your repayments are going to pay off interest rather than principal. So if you can make an additional lump sum repayments onto your mortgage, that could have a fairly substantial impact on either lowering the term of your mortgage at the back end or reducing your remaining repayments. So it would be seen that if you do come into a bit of cash for whatever reason, it might be worth your while to make an early repayment. Not all banks will accept that. So you'd want to check that out with your lender if that's the case. And typically, again, if you're on a fixed rate, it becomes a little bit more problematic to do that. So again, it's a question that is worth looking at. And the last one that I have here is, can you take advantage of a lower LTV? What the hell does that mean? That's a loan to value. So again, that's this idea. In the example that I had on earlier, you had the person was looking for to buy a house worth 250,000 and they're being lent 225. That's a loan to value of 90%. As you start to repay more and more of the mortgage, and as house prices typically go up, then over time you will find that that loan to value number starts to decrease. So it might have started off at 90, and maybe in 3 years' time that might be at 80%, and maybe in 5 years' time it might be at 68%, and it might start to slowly but surely kind of work its way down. Well, as you get down to say 60 and 55 and 50% loan to value, and many banks offer cheaper mortgages for lower loan to value rates. So if you have got, and that's because from the bank's perspective, it's much less risky. The chances of them being caught out is very small. So in those instances, they would typically offer a lower rate of interest. And for some banks, the threshold is 60%. For other banks, the threshold is 50%. So, it might be worth your while if you're on a variable rate and you've been on it for a while, it might be worth your while to look at that to see, I think I might be now down at a loan to value rate of 48%. Maybe I might be able to shop around and get a better deal. So again, my advice in all of this, if there is advice to be given, is to look for advice and to shop and to see, if you ever see the stuff that people that most of the commentators would say in this, people tend not to switch. And you can quite often get better value for money if you take a look around and see what's out there. If you just flick on, I don't know what I have next on my next slide, Ashton. Yeah, I've talked about the interest rates. The current ECB rate is 2.5. That's what banks can. Can put money on deposit with the ECB, and then when they're borrowing from the ECB, it's 2.65%. That kind of sets the threshold for interest rates. Savings rates for deposit accounts tend to be lower, and and then obviously the mortgage rates tend to be higher at about maybe 3%. And a fall, if that rate does come down, then the likelihood is that the interest rate, if the bank passes it on, your interest rate should fall as well too. ECB tends to work in 0.25% changes at a time. What drives the interest rate? Well, typically, I suppose, what drives interest rates are general economic conditions and inflation. So if I suppose, and in the main, it's inflation. The ECB have a mandate to maintain inflation at a certain number. So they try to maintain inflation at 2%. And if the inflation rate is ticking above 2%, then they'll try and take some money out of the economy by increasing interest rates. If the interest rate is the inflation rate is below 2%, then they'll try and encourage people to spend by lowering interest rates. And at the minute, our inflation rate across the EU countries is in and around the 2% mark, which is why the ECB is starting to lower interest rates. Because if you can recall, if you look back around the time Vladimir Putin invaded the Ukraine, that caused a huge spike in energy prices. That led to inflation. So therefore, the ECB upped interest rates up above 4%, and now slowly but surely they're resetting them back down as inflation has worked its way out. I'm not sure if I've got much more. Do I have another slide to go? No? Okay, just some good resources. If you're looking for some independent advice, the Money Advice and Budgeting Service is a free service that works with people, particularly if you're having difficulty with managing your debt repayments. Again, it's an independent service. It is not provided by any company or any mortgage, anything. Nobody's connected with anybody, and it's, I suppose, managed through, it's a quasi-governmental, I guess, if you want to call it that as well too. And then I think if you go on to the next slide, some other, I've mentioned already, the CCPC, good source of independent tools as well, and the Citizens Advice Bureau gives some good information about kind of basic financial products also. And I don't know if there's much more. I don't think I've much more than that. I think I've gone on a bit. Now we're coming up on quarter 1 at this stage. I know there's something in the chat.
Yes. We just had one question in relation to the post office savings rate, and it was, are the rates the same when saving in the post office? So it'll depend on the provider. So the post office will have their own interest rates on savings accounts and savings products, so have a look on their website. They'll show you what they'll offer, and they'll often offer higher savings rates if you're looking to lock up your money in savings bonds for a longer period. So if you're willing to put your money away for 5 years, 10 years, you might get a better interest rate, but it means you can't take your money out and get the benefit of those interest rates unless you leave it there. So all of
Yeah.
the banks will have their own interest rates for their savings products. John mentioned the CCPC for mortgage comparisons. They've also got a savings account comparator on the CCPC. So I would say that again is a that again is an option if you're looking at the different offerings from the different banks. CCPC is kind of a non-biased governmental organization that you can use to compare the different offerings in relation to savings products.
Yeah, and the only other thing with the post office is that many of them offer a portal into the state savings scheme, which is lending money to the government effectively. Okay, so you can do this online with statesavings.ie, or you can go into An Post, who also will facilitate that transaction for you. Whether or not they have better interest rates or not, you'll just have to check out. But it would certainly be seen as being a very safe form of savings for sure, because you're lending to the state effectively, and that can be a bit more, a bit less risky.
I think that was it for questions. Thank you all so much for joining us. If you are interested in anything that we do with the Funds Academy, we have a number of courses around investment funds, investment fund administration, sustainable finance. Do have a look on our website. Both John and my contact details are there. You're welcome to get in touch. You're also welcome to join our Funds Academy page on LinkedIn. fundsacademy.ie is the LinkedIn page, and that will keep you up to date on the various activities that we have running, often in Cork through MTU, or in Waterford through SETU. So thank you again to everyone who took the time to join. I hope you enjoy the remainder of the Cork Lifelong Learning Festival. It was great to have you online. We will be making this recording available through our YouTube channel, and it'll be available if you'd like to share it with any of your friends or family that might find it useful. So thank you all so much.
Thanks, everyone. Take care.
Thanks, John.
Thanks, Ashen.